Infinite banking myths and how to create wealth infinite banking properly. And I realize we're on a Harley right here. I got tired of standing making, I don't know, our 600th YouTube video of the day. So I just decided, let's pull this out and let's just make it from here. So let's talk about how to do infinite banking, become your own bank, and create wealth. Now, I want to just start with the overall goal here. I make 25 to 30% a year on my money with infinite banking, okay? If you are not doing that, then yeah, it doesn't work. It doesn't work, it doesn't make sense. Don't do it, okay? My rule is 25% or more. So the first myth that I hear a lot of people say is, well, you know, if it actually worked, the banks would be doing it. They do. It's called BOLI, bank-owned life insurance. And not very long ago, banks actually accumulated $11 billion worth of bank-owned life insurance. Now, there's another common infinite banking myth that I didn't mention here and kind of goes in between, is most of the policies sold for infinite banking, and by the way, I'm not an advisor, guys. I don't get paid to say this shit, so I'm just exposing the truth, all right? And I've been in the industry from a marketing standpoint for several years, so I've learned how the insurance carriers create products, put a big commission behind them, and incentivize the advisors and the brokerages, the independent advisors, to sell you shit that puts more money in their pocket and less in yours. So I have the context from a very unique perspective to understand this at a very high level. So banks have BOLI, all right? And what the banks buy is not what you are sold, all right? They buy institutional grade, dividend paying, cash value whole life insurance. And what they specifically do is what is called a HECV. It's an acronym to write down, high early cash value. Now, what advisors sell, what almost every advisor sells, including the ones that spread hate continuously on my videos that don't know what they're talking about, they sell IULs, they sell VULs, and if they sell whole life, they do it through companies like Lafayette that have lower returns, lower IRRs, or they sell what's called retail whole life. Now, where I keep my money in a life policy does 8 to 12% IRR. This is a term you need to understand. Internal rate of return, okay? For learning purposes, to double your money in a 5-year period of time, which is my minimum criteria. My minimum criteria is I must double my money every 5 years. To double your money, you have to have a 14.4% IRR, okay? I'm gonna get into my wealth building strategy with infinite banking in a second here. Let's go back into the myths. The next thing is, people think you gotta be rich to do this. You do not need to be rich. Yes, John McCain used infinite banking to fund his campaign. JCPenney used infinite banking. Ray Kroc used infinite banking. Walt Disney used infinite banking. Obviously all multimillionaires, billionaires. You do not need to be rich to do this. When I started doing infinite banking, I actually only had about $600 a month to put away into a policy, all right? And this is kind of going into a nuance, but what I did is I started contributing to a policy, and at a certain point, it built up some cash value, and when I had a big enough chunk to fund the policy more, I opened up another policy, all right? You can get really creative. You can start low now, then later on when you have more money, you can contribute to a bigger policy. You can do what's called a 1035 exchange, and you can combine the cash value from one policy into a new policy that you open up and start with a higher amount. There's all these different things. It's not for the rich, okay? There's policies that can be designed for every single level of person, regardless of where you're at in life, okay? Another misconception is that it's expensive, all right? And in a second here, I'm gonna compare the returns in a properly structured whole life to the S&P, all right? Because a lot of people would say, well, another myth, just invest in the S&P. No, it's expensive. If you have stage 4 cancer, if you weigh 436 pounds, and your heart is about to explode, if you've been a smoker for 738 centuries, if your lungs are black, if you wake up every morning and shoot up black tar heroin through your anus, yes, it would be expensive, yes. But for the average, everyday, working class American that is in okay health, maybe not the best, maybe not the most amazing, from what I have seen, most applicants get approved, all right? A lot of people that have, pre-existing health issues are able to get approved and get some sort of structure set up. Now, insurance costs can vary, but that's why we do institutional grade HECV. It's designed to have early cash value accumulation, and it's designed to be overfunded, okay? Overfunding is critical. There's a lot of carriers out there like Lafayette is one of them, all right? Lafayette has restrictions to how much you can overfund a policy, all right? And there's something called a MEC limit. It stands for Modified Endowment Contract. And a MEC limit essentially means there's a limit to how much you can overfund a cash value policy. And usually that's about 2.5 to 3x the initial amount you put into a policy, all right? So you want to have a policy that allows you to overfund the shit out of it as much as possible without hitting the MEC limit, okay? It doesn't have to be expensive. And I'm going to break that myth in a second here, because everybody thinks that with infinite banking you have low returns, maybe lower than the S&P, okay? Now, if I'm getting 10% in the S&P, which is a realistic number, all right? If you go to withdraw your gains, okay, you put $10,000 into the S&P and it grows at 10%. So you've got $11,000 and you take that $1,000 of profit. You're gonna pay capital gains taxes. And so your effective return is not 10%, it is 8%, okay? Well, I make at least 8% IRR, internal rate of return, in my policy, okay? I can't borrow with 100% leverage against my S&P because it's volatile. The market could crash, it could go up, it could go down, it could go sideways. This is going up 8 to 12% year over year over year over year. And when you are invested in a high early cash value, dividend paying, institutional grade whole life policy, you get two things. You get a non-guaranteed dividend. They call it non-guaranteed because if the company went insolvent, it became not profitable, they wouldn't pay that dividend. Now, the company that I use, which is Mass Mutual, and there's a lot that are really good, all right? There's a lot of good carriers, 5 specifically in my opinion, has never had a dividend less than 6% in 50 years. That dividend is tax-free. As a matter of fact, that dividend is 6.4 this year. Then you also have what's called a guaranteed return, which typically varies between 2 and 4%, minus 4%, okay? So I'm getting a couple benefits there, and the dividend, again, is tax-free. So now I'm kind of gonna draw a box in here, and I will talk about my investing strategy in a second. This is my bank. This is why they call it infinite banking. I am becoming my own bank. I am my own bank. I don't keep my money in the checking account. I keep just what I need to pay bills. I invest my money in here. Where I keep my money is making 8 to 12%, all right? And then I go into assets that do at least this, at least that, okay? Which means I'm doubling my money here every 5 years. And if I'm actually getting 8% here, it means that I'm more than doubling my money every 10 years, right? If we take the rule of 72 and we're getting an 8% return, 72 divided by 8, 9 years. Every 9 years, I could have done that math. Every 9 years, I'm doubling my money here, and every 5 years, I'm doubling my money here. So if I add these up, right, what's my IRR? 14.4 plus 8, okay? So when I'm talking about I don't put my money, I don't invest my money anywhere where I'm making any less than 25%. This is why. So I go into real estate deals and I go into oil deals. Oil deals that allow me to write off my investment capital in the year I invest. They give me cash flow with tax benefits, okay? And I get big paydays on the exit, plus I can 1031 that exit. And all I do is rotate between these two assets. Now, I've made other videos talking about this and I've pulled a couple deals up. There's a real estate deal that was a 19.1% IRR. So it's doing, it was a 5-year deal, 2.37x return in 5 years, all right? So if I am keeping my money here, okay, and then I am using that to invest in a deal that's not 14.4, it's 19.1% IRR, I'm making 8% IRR here, and I'm making 19.1 over here, right? That's a 27 and some change IRR combined. That's huge. Now, if you go to your financial advisor that keeps you in the stock market or keeps you in a retirement account, you do not have that leverage. You are exposed to inflation. You pay more taxes, okay? If I am not more than doubling my money every 5 years, it makes no sense. I'm doing something wrong, okay? So that is infinite banking done right. Your myths. It's better than the S&P, okay? You can get good returns. They are not low. 8 to 12% outperforms the S&P when you're paying less taxes and you can borrow against the cash value using a line of credit. and invest in assets that at least double your money every 5 years. It does not have to be expensive. It's expensive if you are morbidly obese, or you're set up with a bad carrier or with a shitty financial advisor, which is most of them. It's not for rich people. And the banks invest in it every damn year, okay? So do you want to keep investing like the middle class? Or do you want to invest like a capitalist, like the wealthy? This is what I do by profession, guys. There's actually a link I'll include in the description to the Capitalist Network. You can get a 7-day free trial. We provide the mentorship. You get direct access to me, all of my wealth building partners. We get you into the oil funds. We get you into the real estate funds. We get you the tax strategy. We help you get access to the institutional grade financial products like what we're talking about, and help you get access to the line of credit so you can leverage. And I want to end with 2 things here, okay? If you guys have any questions, let me know in the comments. By the way, I answer all of my questions. And if you're brand new to the channel, consider subscribing, because I drop several videos every single week on building wealth, lowering taxes, achieving financial freedom, creating leverage, hedging against inflation, and truly multiplying. And it's why I like to be in hard assets, oil and real estate. It doesn't need to be sophisticated. It doesn't need to be a crazy strategy. I don't need my hands in 10 different things. I need to go all in and what I know, like, and understand. And when you understand an investment, it becomes less risky. You're able to go deeper in it, and you're able to multiply wealth. So, in the whole life, that's my bank, all right? It's going up in value. So I take my earned income and I keep putting it in here, not my savings account. I pay less taxes, I have more leverage, and I have higher growth. Every year this grows, okay? Let's just say this is 100K, okay? Every year this grows, like this. That cash value grows. I'm increasing my line of credit. So every year I increase my line of credit, I'm able to go into a real estate deal or an oil deal with more capital, more leverage, all right? And so every time I do that, I take the profits from this, the cash flow, the exits, the tax benefits, the money I'm keeping in my pocket, and I pay the line of credit back, and I repeat the process, okay? And that's how I'm able to multiply my wealth. Guys, have any questions? Let me know in the comments, and I'll see you in the next video.